Ladies and gentlemen, when you hear people talk about the S&P 500, you probably think there's absolutely zero way to time it and that all you have to do is throw all your money in and hopefully by the time you're 60, you'll have enough money from your investments to retire. Now, obviously, investing in the S&P 500 in the first place is 10 times better than not investing anything or doing nothing with your money at all, which most people actually do. However, what if I told you that a 17-year-old kid, me, built an S&P 500 swing trading strategy that basically makes it impossible to lose money on your S&P 500 investments. And the crazy part is that it only uses two simple indicators to make this work. Yes, I know it sounds absolutely insane, but over the past few months, I've been using this strategy, and it lets me enter the S&P 500 when everyone else is panicking and exit when everyone else is greedy. By the end of this video, you are going to completely understand this strategy as I walk you through it step by step. Now, this is just for YouTube purposes, but this is not financial advice. This is just what I've been doing, and it's been making my money completely inflation-proof. So with that being said, let's dive straight in. Now, before we jump into the strategy, guys, we need to make sure that we're on the same page with a couple of important terms. Once you understand these three simple terms, guys, understanding the entire strategy will become extremely easy. So first of all, guys, we have RSI, which actually stands for the Relative Strength Index. This is used for the S&P 500 to measure how fast prices are moving. It compares the strength of a stock on up days and down days. So the simple strategy here is that when the RSI is above 70, as you can see on the slide, the market is considered overbought and the S&P 500 will most likely be going down. However, if the relative strength index says that it's below 30, it's often considered oversold, which means that the S&P 500 will most likely be going up. So in other words, guys, the RSI tells us when people are buying too aggressively or when people are panic selling. So the second definition, guys, is the VIX, or the Volatility Index. This is often also called the Fear Index because the VIX represents the market's expectations for volatility over the next 30 days. It's derived from the S&P 500 index options and generally rises when the stocks fall and drops when the stocks rise. Usually a VIX reading of above 30 signals fear and uncertainty, while a VIX reading of below 20 suggests that the markets are calm. So those two previous definitions, guys, the RSI and the VIX, are the two things that I look at when I am predicting the future of the S&P 500. However, there is one more definition we need to go through, guys, and that is inflation. Inflation is the gradual loss of purchasing power reflected in a broad rise in prices for goods and services. When inflation occurs, money loses its purchasing power, so I keep an eye on it because it can influence the market's mood. And just to talk to you guys about a massive mistake really quickly before we get into the actual strategy, this is a massive mistake that a lot of people make. Normally what people do is they'll put all their money into a savings account instead of an index fund like the S&P 500. And what they don't realize, they think, oh, they're being super safe with their investments, but it's actually not an investment because their money isn't working for them. They think that they're being super safe with their money, but inflation, which we just talked about, is actually making their money lose value. So that's why I said in the beginning of this video that even putting your money in the S&P 500 is actually 10 times better than just putting it in a savings account or just a bank account in general. However, as good as putting your money in the S&P 500 or a similar index fund actually is, what I've realized is that it's actually not enough. And that's why I created this strategy that we are about to get in right now. But before we get into the rest of this video, guys, make sure to do two things for me really quick. First of all, subscribe because I have a lot of wonderful business videos planned for the channel just like this. And two, guys, make sure to follow my Instagram because I give behind the scenes sneak peeks of upcoming videos. The link for that is in the description. Now, guys, it's time for the part you've all been waiting for. Let's get into the exact swing trading formula. So here's what's been working for me, guys. I created a formula that waits for the extremes in the RSI and the VIX and act only when they align. So here is the ultimate formula, guys. You buy when the RSI is below 30 and the VIX spikes above 20. This makes sure to signal that people are panic selling and that the volatility is high. However, you sell, and you don't have to entirely sell. You could take a percentage of your profits, but most likely you do this when the RSI is above 70 and the VIX falls towards 15 and 20. Closer to actually under 15 is better, but this tells us that the market is overheated and complacent. So you need to think about it like this. Think that the RSI is telling us when the market is tired, and the VIX is telling us whether that's fear or greed. All right, so now guys, we're going to cover exactly when I buy into the S&P 500 using this strategy. Like I said, guys, the RSI and the VIX are perfectly tied to the S&P 500's performance. So this is what we're going to look at. First of all, we're going to look and see that the RSI is below 30. We're waiting for this indicator to dip into oversold territory. Next up, we're going to see that the VIX spikes above 20, because if this is the case, then the S&P 500 is most likely already steadily dropping, and once this spikes, it will go up. Next up, guys, we're going to actually look at the price and the graph of the S&P 500, because the price needs to be near the support level. When these conditions are met, you can start scaling in. You don't have to go all in, but you could at least start scaling in. And doing this will minimize your losses if it does go down further, but you guys already know that it will end up going up in the future again. So there's really no need to worry, guys. That's literally it. That's not complicated at all, but that is when I buy, and those are the things I look for when I scale into the S&P 500. Next up, guys, we're going to do the exact same thing except with when I sell. So selling is where most people struggle because greed clouds their judgment. So this right here is how I avoid holding the bag. When the RSI is above a 70 reading, this is when the market is entering overbought territory and everyone is being complacent and blinded by how high the S&P 500 is actually going. And then also I look at the VIX chart, obviously, and this one has to be near 15 for when I would start selling out profits. Because when the VIX does creep down to 15, that's when complacency sits in and no one expects the S&P to drop. Another thing I also check is the S&P 500 chart again. Normally, if it's 3 green candles in a row or 3 profitable weeks in a row, that is a good sign to check the RSI and VIX charts and see whether or not to scale out profits. Another mindset thing to keep in mind, guys, is you don't need to catch it and sell at the exact top. It's better to sell as it's gonna start going down than actually catching it on the exact top. The best strategy is to lock in your gains and move on before it ends up dropping, and then you can buy in again once it drops. So ultimately, guys, you can see that this is way better than just buying into the S&P 500 and just having your money sit there as it fluctuates. It's ultimately to just better look at the VIX and RSI charts and buy when it's down and sell when it's high. This will be 100% better than just having your money sit in your S&P 500 account and have it fluctuate. So now, guys, since all of this might be a bit confusing, we're actually going to look at a real life example of what happened a few months ago with the S&P 500 and how this would be a gold mine for swing trading. And if any of you guys watching are actually invested in the S&P 500, you will remember this chart that I'm about to pull up. This right here is the 6-month S&P 500 chart, and as you can see in February, specifically February 19th, that is when the S&P 500 hit 6,144. And then after that, we saw a crazy drop all the way down to Tuesday, April 8th, which the S&P 500 hit a crazy low of $4,982. As you can see, guys, after that, it took all the way until June 26th to hit its original high price of 6,141. So that right there is months of wasted time. Now here's where I'm actually going to show you a successful play out of the strategy we just talked about. As you can see, if you absolutely did nothing with your S&P 500 investments, it would have taken 4 months for this entire cycle to go through, and that would have been 4 months of you just making absolutely no money. However, a successful playout of this strategy would have started on February 19th. Let's just say, for example, you sold all of your position on February 19th and locked in your profits. Then what you could have done is paid attention to the RSI and VIX charts, and let's say you pulled off a perfect play and entered all in again on April 8th. Just imagine all of the profit you would have made. That's over $1,000 that you just made off of each and every S&P 500 share that you would have had. I'm not sure of the exact percentages, but I'm pretty sure that that's around 20% profit. That is absolutely insane, guys, because let's say you had a portfolio of around $50,000. I'm pretty sure that that would be around 8 shares at the time of the S&P 500. And with those 8 shares, if you exited at around February and entered in April, you would have made well over $9,000. That is an insane net profit, guys, because most people just took the loss and hoped it went up again. So now let's compare that to if you did nothing, you would have made around $300 per share. Multiply that by 8 shares and you still would have had a net profit of around $2,500, but that's nothing close to the near $10,000 you would have gotten just by swing trading this portion. So yeah, guys, obviously these numbers are quite simplified, and past performance definitely doesn't guarantee future results, but this is just the insane strategy that I just taught you. So that is ultimately the entire strategy. Learn the indicators of the RSI and the VIX, wait for extremes, and control your emotions. So yeah, guys, ultimately, if you enjoyed this breakdown or learned something new, make sure to like and subscribe and comment your thoughts. Obviously, investing in the S&P 500 in the first place is 10 times better than just putting your money into a savings account. But doing this strategy that I just talked about is also 10 times better than investing in the S&P 500 in the first place. So yeah, guys, I've got a ton of great videos coming up: finance, entrepreneurship, and lifestyle vlogs. So make sure to subscribe, and I'll see you in the next one.